Would you ever sell calls?
Would I, could I, should I? Yes, I would sell calls. Wish I sold more calls today. You mean the S&P down 73?
I'm looking at some of these markets and none of this is easy. Why would you ever sell calls?
For a day like today, I answered you already.
I agree with that. Let's take a look. And they're really talking about why would you ever sell calls if you sell a strangler or a, something like that. But
Right.
let's see. So we did a study on the probability of an underlying continue to go against you after you're tested on either side of a strangle. The results, although biased due to a bull market over the last 14 years, show that calls get tested more often than puts, and the underlying trends continue to rise even higher after they're tested. That's what we call positive drift to the nth degree. Considering that calls are cheaper to begin with than puts, so why would we ever sell calls? Do you think that calls helped you, hurt you, or did nothing over the last 10 or 15 years?
I'm going to say it was pretty much a wash over the last 10 or 15 years. And if you were to go back 30 years, it'd be a big gain.
That's exactly what I would have said. I would say that over the last 10 years that we've been in a pretty strong bull market, calls probably didn't help you that much. But if you went back longer than that, calls absolutely have helped being short calls. And it's impossible to time the market like that. So as long as they don't hurt you, and I don't think they hurt you, I think you got to be short calls. And we get that question all the time. Why don't you just sell puts? Puts are schmutz. This is a 14-year study, 45 days to expiration, managed at 21 days. So this would be the time frame from 2010 to 24. We had the strongest bull market. Sold at 20 delta calls, 20 delta puts, and 45 days to expiration. Let's go to the next slide. So from the following table, we have to keep in mind that 65% of the time, we have a market that went higher, which is unfavorable to calls. Yes, it's usually much lower than that, like 53, 47. But the last 14 years, it's been 2/3, 1/3. We've been higher. So 45-day periods, looking back at 14 years, the percent of positive returns, 65. Percent of negative returns, 35. That's crazy out of balance. The big question everybody has is that going to come back into line over the next 14 years? I don't know.
I don't know either.
The key trade-off of selling calls versus puts in equity products is the added outlier loss that puts are exposed to. The worst loss on a 20 delta put in the SPY was two times more than that of a 20 delta call. However, the standard deviation and the CVAR are basically the same. So you can see the win rate up here on the calls is about 64%. That's why you sell them. The win rate on the puts is 85%, but the calls have a negative P&L, and that's over that 14-year period. The worst loss in the calls, half of what the puts are. CVARs and the standard deviation, that's the amount of volatility, are about the same. So why would you sell anything that has a negative P&L over 14 years? And we're gonna take you into that because this doesn't take into account, by the way, IVR, and doesn't take into account managing early or any of that kind of stuff. Selling the 20 delta call is a negative P&L in a rising market because of the potential for significant losses if the market moves against your bearish bet. This is the same slides we just showed. Does not take into account, like I said, for selling only in high IVR, does not take into account for managing early, which will change these statistics somewhat, but it is interesting nonetheless. And this is the reason we did this whole discussion. Why sell this when that number is a negative number? If an asset's price drops below the put strike price, you could be exposed to an outlier loss. By selling the call, you retain the premium from the call, which would mitigate the outlier loss on the put. Therefore, selling a 20 delta call had a positive P&L in falling markets because the premium income helps to mitigate the loss of the short put. So yes, which would be a surprise to no one in down markets, being short the call really helped. Although the calls, and this is the really good takeaways, although the calls are cheaper and more susceptible to positive market drift over time, the worst case outlier is far less dangerous than the put side, especially in SPY. Even during the above average bull market since 2010, selling the 20 delta calls in the SPY essentially resulted in breaking even. Although the probability of profit remained high, both the conditional value at risk and the standard deviation were relatively similar with selling a put. So the bottom line is it didn't really cost you. It did protect you on down moves. It didn't really help you, but over time, and if you take into account high IVR and managing early, it helps.